Hi everyone, I'm Sean, Head of Investments at Endowus. With me is Yuhan, one of our investment leads from the Endowus Investment Office.
For those who are new to us, Endowus is Asia's leading fee-only wealth platform that offers advised investment portfolios and funds across both Singapore and Hong Kong. We were the first to introduce 100% cashback in trader fees, allowing us to be independent and fully aligned to our clients' needs by not receiving kickbacks or commissions.
We want to help you invest better to live better. And we aim to do so by offering expert advice with access to solutions that were once only reserved for large institutions at low and fair fees.
Today's session will include a brief market recap, key updates on what lies ahead, and how our portfolios did. First, let's examine how the markets performed in Q3. Having staged a strong rally in the first 7 months of the year, consecutive losses in August and September brought markets firmly back down. Optimism over the likelihood of a soft landing was replaced with fears over a renewed hawkish Fed stance, while persistent issues with the Chinese economy erased any lingering hopes that a robust recovery could help bolster the global economy. The major developed markets of the US and Europe both suffered declines over the quarter. Potentially higher interest rates for longer led to weakness in the US technology sector, while in Europe, the consumer discretionary sector sold off on fears of the impact to discretionary spending. Consistent with the reversal in market sentiment, growth stocks underperformed their value peers, although on a year-to-date basis, the MSCI Equity Growth Index remains well ahead of the MSCI Value Index. Moving on to fixed income, the global fixed income market saw a series of significant developments in the third quarter, sparking concerns and raising questions about the future of fixed income investments. The surprise downgrade of the US by credit rating agency Fitch garnered public attention, with the turbulence within the US amplified by renewed brinkmanship around its debt ceiling and political discord in the House. Inflation fighting remains the central theme, with bond prices declining in most developed markets, as the realization set in that rates may remain higher for longer. This continued a recent pattern of positive correlation between equity and bond markets. While the steepness of the yield curve's slope has since moderated from its peak earlier this year, it continues to be inverted. Corporate bonds outperform government bonds, with the riskier segment of bond markets faring better than its higher quality peers.
Let's now discuss what investors should be watching out for in Q4. First, on the Fed, the latest September Federal Open Market Committee minutes indicate one more rate hike coming before the end of the year. This suggests that both economic conditions and inflation concerns remain on the Fed's radar, motivating them to advocate for a continued tightening of monetary policy. The outlook for 2024 is equally noteworthy. When we look at the Fed dot plot, it suggests a period of sustained higher interest rates. Both equity and fixed income markets, which had already been nervous since August, reacted negatively to the relatively hawkish tone from the September meeting. Long-term Treasury yields rose further, driving bond prices down, and equity returns took a nosedive. Thus, further uncertainty lies ahead in the second half of 2023. Investors will assess how central banks balance between a growth pullback on one hand and cooling inflation on the other. To top it off, there are no shortage of dramatic headlines to keep investors fearful or exuberant. On fixed income, one question on many investors' minds is, can fixed income be fixed? Investors seeking safety in fixed income this year would have been disappointed by the meager to flat returns returned by the broad fixed income market. If we look at the Bloomberg Global Aggregate Index, it has seen close to no returns in Sing dollar terms thus far this year. Yields for cash and money market instruments have also risen along their longer duration peers, leading many investors to forsake longer dated bonds for the security and liquidity of treasury bills and money market funds. While holding on to cash investments may seem prudent in the current market environment, the yields for broader fixed income instruments beyond money market and treasuries are attractive versus history, and thus may represent an investment opportunity for long-term investors who can consider taking on some credit and additional duration risk. While the higher for longer interest rate narrative may continue to drive fixed income and equity markets, keep in mind that in flat or falling interest rate periods, bonds have typically outperformed short duration treasury bills. It is hard to predict how long the Fed will keep interest rates high, but when the economy starts to deteriorate, interest rates are likely to drop, driving bond prices up. The equity market picture is a little more mixed. The US equity market saw a strong first half, a turbulent third quarter, where growth underperformed value, but is still outperforming year to date. The higher rates for longer narrative put pressure on the prices of the Magnificent Seven, but they continue to drive a large part of market performance. All in all, this reminds us that the market remains, as always, hard to predict, and thus the prudent choice in our view is to have a globally diversified equity portfolio that makes up most of your investments, and if you like, you complement this with a tech fund or an actively managed fund. This is known as a core satellite investment approach. We'll now take you through a review of how our advised portfolios did in third quarter. The Flagship Cash and SRS portfolios generated negative returns but outperformed their respective equity and fixed income benchmarks in the third quarter. The equity sleeve beat the MSCI All Country World Index by about 0.4%, while the fixed income portfolio bested the Bloomberg Global Aggregate Index by a larger 0.7%. In a reversal from the first half of 2023, value stocks outpaced growth stocks in the third quarter. In the same period, one of the best performing regions was emerging markets. A 100% equity portfolio benefited from its structural biases, being value-focused and with a slight overweight to emerging markets, managed to outperform the benchmark as a result. On the equity lineup, the Dimensional EM Large Cap Core Equity Fund emerged as the best performer. The 100% fixed income portfolio outperformed the global fixed income market, helped primarily by its larger allocation to corporate bonds relative to the index. Corporate bonds outperformed the sovereign debt in the third quarter. The PIMCO Income Fund was the best performing fund in the fixed income lineup, benefiting from its shorter duration positioning. The Flagship CPF Portfolios posted negative returns for the third quarter, similar to its benchmarks. The 100% equity portfolio underperformed the broad global equity market, while the 100% fixed income portfolio outpaced the global fixed income market by about 0.3%. Equity underperformance was largely driven by the First Sentier Dividend Advantage Fund and the Schroeder Global Emerging Market Opportunities Fund. The First Sentier Dividend Advantage returned negative 6.7% for the quarter, and the relative underperformance was mainly driven by its holdings in China, pummeled by weaker investor sentiment. The primary detractor for the relative performance for the Schroeder Fund was the team's stock selection, particularly in Brazil and China. During the third quarter, we added the Amundi Global Aggregate 500 Million Index Fund to our fixed income portfolios at a significant weight. While this has brought the overall duration of the portfolio closer to that of the benchmark, the Bloomberg Global Aggregate Index, it still tends to have a slightly shorter duration relative to the benchmark. This helped as longer-dated bonds underperformed shorter maturity bonds. The United SGD Fund, with its shorter duration and more conservative positioning, was the best performer in the lineup. Onto our factor portfolios by dimensional. The Factor 100% equity portfolio outperformed its benchmark, the MSCI All Country World Index. The portfolio's allocation to the Emerging Market Sustainability Core Equities Fund and the Pacific Basin Small Companies Fund were the primary drivers of its relative outperformance. The underweight to Europe and a slight overweight to emerging markets contributed from a geographical standpoint. The fund benefited from its value bias. The Factor 100% fixed income outperformed its benchmark, the Bloomberg Global Aggregate Index. The portfolio's allocation to the shorter duration funds, the Global Short-Term Investment Grade Fixed Income Fund, and Global Short Fixed Income Fund contributed to the portfolio's outperformance, as bond yields rose and longer duration bonds suffered. Onto the Endowus ESG Portfolios. The ESG 100% equity portfolio underperformed the MSCI All Country World Index in the third quarter. The portfolio's security selection, in particular within financials and utilities, was the main detractor. Additionally, the portfolio's lack of exposure to the energy sector hurt, as energy was the best performing sector during the quarter. The ESG 100% fixed income portfolio outperformed the Bloomberg Global Aggregate Index in the third quarter. The portfolio's underweight position and duration contributed to relative performance. Additionally, its allocation to investment-grade credit and high-yield bonds contributed, as both asset classes outperformed the Global Aggregate Fixed Income Index during the third quarter. The companies in the Endowus ESG portfolios continue to demonstrate how businesses can also be responsible stewards and deliver positive societal and environmental impact. Endowus is actively reviewing the ESG data as these metrics become more available and reliable. Turning to our income portfolios. A reminder that we have 3 income portfolios: stable, higher, and future, with different underlying asset allocations, funds, and target payouts. The stable income portfolio outperformed the Bloomberg Global Aggregate Index in the third quarter. Overall, the portfolio's shorter duration relative to the benchmark, as well as its yield curve positioning contributed. Additionally, its allocation to investment grade and high yield corporates, as well as allocation and security selection in certain securitized sectors also contributed. Its allocation to Asian bonds, however, slightly offset this outperformance. The higher income portfolio outperformed the 2080 equity fixed income composite index. The fixed income portion of the portfolio outperformed the Bloomberg Global Aggregate Index, as its shorter duration positioning and higher allocation to high yield corporates contributed meaningfully to relative performance. The equity portion of the portfolio underperformed the MSCI All Country World Index, with the portfolio's allocation to real assets being the biggest detractor. Currency hedging also hurt relative performance as the US dollar appreciated against the Singapore dollar during the quarter. The future income portfolio slightly underperformed the 40/60 equity fixed income composite index. The underperformance of the equity portion of the portfolio was the biggest detractor, while the fixed income portion of the portfolio contributed positively to relative performance. Within the equity portion, the emerging market equity fund, Asian equity fund were the biggest detractors. On the payout front, all three income portfolios continue to achieve their payout objectives. Actual payout has remained stable despite the fluctuation of prices across the three portfolios. While volatility in price returns will result in mark-to-market change, decrease or increase in the portfolio value, it does not impact the actual coupon payments or dividend payout from the underlying funds. Yields in the fixed income market have risen meaningfully following the increase in global interest rates. This should be a positive for income-seeking investors. On to our cash-smart portfolios. All three Endowus cash-smart portfolios maintained the positive momentum, delivering positive performance in the third quarter and year-to-date. CashSmart Secure, with its ultra-short duration position, continued to capitalize on the prevailing high base rates in the market. CashSmart Enhance continued its positive trend in September and throughout the third quarter. Despite challenges in the Asian fixed income sector and tensions in the Chinese market, underlying funds like the United SGD Fund remained defensively positioned, with a focus on high-quality and short-duration bonds in the Asian region. CashSmart Ultra saw a slight decline in September, but managed to end the quarter in the green. The dip in performance can be attributed to the underlying funds, including the Nikko Shenton Income Fund, which continues to have a China focus and longer duration. Regardless, the portfolio received a boost from other funds, contributing to an overall positive performance for the quarter. We have been observing signs of yield peaking and staying at the prevailing high levels as central banks and policymakers around the world near the end of their rate hike cycles. CashSmart portfolios are largely exposed to US dollar and Sing dollar market rates that are widely believed to stay elevated for longer. The CashSmart portfolios can capitalize on the prevailing higher levels of yield, while the active management of the underlying fund managers allows the funds and ultimately the portfolio to benefit from capital appreciation opportunities when markets enter a rate cut cycle in the upcoming months or years. Finally, we'll take a look at our satellite portfolios. A reminder that the Endowus satellite portfolios are designed to supplement the core portfolios and offer clients specific exposure to opportunities in selected regions, themes, asset classes, and trends. In taking a core satellite approach, most investors should allocate the bulk of their asset allocation to the core portfolios. The Endowus China equity portfolio underperformed the broader benchmarks over the third quarter. While positive stock selection and an underweight to communication services contributed to performance, this was offset by an overweight to and negative stock selection within the information technology sector. Within the China fixed income market, weak investor sentiment, dwindling liquidity, and dashed hopes for broad-based easing has led to a rise in bond yields despite rate cuts by the PBOC. The Endowus China fixed income portfolio declined over the quarter, with the Neuberger Berman China Bond Fund detracting the most on a relative basis. The low volatility fixed income portfolio underperformed its reference benchmarks during the third quarter. The fund's main allocations to the flexible strategies, the Legg Mason Brandywine Global Income Optimizer Fund and the PIMCO Total Return Bond Fund were the main detractors due to both funds' relatively longer durations. The Megatrends portfolio declined in the third quarter, as market sentiment soured in August and September on the back of the US Fed's hardening stance. While the portfolio was largely able to keep pace with the MSCI All Country World Index in July, its higher market beta and growth tilt led to larger losses in August and September. The Endowus Technology Portfolio underperformed the broad equity market by about 2.4% for the third quarter, 3 months that saw the IT sector witnessing significant fluctuations. On a year-to-date basis, the tech sector, and thus the technology portfolio, continue to exhibit strong performance versus global equities on both an absolute and relative basis. The global real estate portfolio performed similarly to its reference indices during the third quarter. The portfolio's two largest holdings, the Janus Henderson Horizon Global Property Equities Fund and the BlackRock Global Real Asset Securities Fund, performed in line with their respective benchmarks. An industrial sector overweight weighed on performance, while an overweight to Japan helped performance. Thank you for listening in, and we hope these insights and updates will help to guide your investment journey.
If you have more questions, please feel free to reach out to our client advisors through the links in the description below. Subscribe to follow Endowus on YouTube to stay updated on our video content. We'll see you next time.